Hello, everybody, and welcome back to the session. Today we're going to be covering the inversion of the yield curve and its use in predicting economic downturns like recession. What is the yield curve? The yield curve is a graph showing the relationship between the maturity of bonds, maybe 3 months, 1 year, 5 year, 20 year, plotted on the x-axis, and then on the y-axis you've got the yield or the interest rate associated with each of those maturities. Now, a normal yield curve is going to be upward sloping, meaning that as maturity gets longer, the yield or the interest rate attached to that maturity increases as well, right? This indicates that at a longer maturity, debt is priced at higher interest rates. Why might this be? Well, investors demand a liquidity premium. In having to wait longer for the return of their investment, they need additional compensation for the time. An inverted yield curve means that the curve switches to a downward slope. Interest rates on short-term bonds become higher than interest rates on longer-term bonds. Now, economists haven't agreed on why this relationship exists, but going back 50 years to 1968, an inverted yield curve, maybe it's the 2-year over the 10-year, maybe it's the 3-month over the 10-year, maybe it's the 2-year over the 5-year, but an inverted yield curve preceded every one of the last 8 recessions. Now, a little bit of a caution here. Some people will say that maybe the yield curve predicted 9 of the last recessions, meaning that there might be some over-prediction involved here. The curve was briefly inverted by some measures in 1998 with no recession following, and most recently in 2022 through 2024, we've had probably the longest duration of yield curve inversion, and no official recession has been called. So one key for economists is, why does this relationship between an inverted yield curve and recession seem to hold? What's the explanation? There are competing theories as to why the inverted yield curve might be associated with a recession, but we haven't really settled in on exactly which one is driving that relationship. Now, one of these theories, one of the popular orthodox theories, is called the Fisher effect. So long-term rates in this model are seen as an average of near-term rates prevailing over the maturity of the bond. For instance, a 5-year bond and the interest rate attached to it is just an average of the short-term rates expected to prevail in each of the 1-year periods comprising the maturity of the 5-year bond. So these you don't know, so these you have to form an expectation of. And these expected real rates include inflation expectations. If inflation is expected to rise over the future, we'd expect the rates in the future to be higher, and so the average of them will be pulled up, and the rates on longer-term bonds will be higher than those of shorter-term bonds because they include these higher inflation expectations from the future. But if recession in the future is expected, then we'd also expect inflation to be softer than otherwise, and so those longer-term rates would have a lower inflation premium in them, and thus long-term rates could fall below current rates, or weaker expected credit demand in the future might cause the same sort of phenomenon. So this is the Fisher effect, and what this implies is that the recession connection is tied to movements in the longer end rates, the rates at the long end of the curve. Now, Paul Krugman, another very popular economist, has an expectations theory that's sort of related to the Fisher theory. Let's look at his. So his is, quote, "The reason for the historical relationship between the slope of the yield curve and an economy's performance is that the long-term rate is in effect a prediction of future short-term rates. If investors expect the economy to contract, they also expect the Fed to cut rates, which tends to make the yield curve negatively sloped. If they expect the economy to expand, they expect the Fed to raise rates in the future, making the yield curve positively sloped." Now, one of the problems with this explanation is that a collapse of long-term rates isn't always what drives the inversion of a yield curve. Instead, it's primarily a spike on the shorter end of the curve, those short-term rates, that ends up popping and inverting the curve. Now, this is validated by Fed research, which we'll see in just a moment. Another issue with this is the circular reasoning, right? So recession expectations lead to an inverted yield curve, but an inverted yield curve causes changes in expectations that make a recession more likely, which brings us to another sort of theory that maybe there's some kind of self-fulfilling prophecy going on here. Maybe it has nothing to do with the yield curve, just the way people react to it, right? A third explanation is from the Austrian school, from von Mises, a Misesian framework, if you will. In this idea, there are periods of economic prosperity, and they are fueled by excessive monetary liquidity. When this monetary liquidity outpaces real growth and real productivity, this easy money artificially lowers interest rates, leading to unsustainable booms. The central bank, well, they primarily affect short-term interest rates, and when central banks tighten, then banks down the line follow, then that tightening of short-term rates inverts the curve, and a recession that's been brewing for some time inevitably happens as the bubble gets popped. Let's talk about a little more of a refined view of the inverted yield curve. And it might be able to help give us a little bit of a stronger recession prediction and clear up false positives. So in looking at a refined view of the yield curve, we want to ask, what are the characteristics of the yield curve that matter, right? What gives us the strongest explanatory power, right? Now, the Federal Reserve has explored this. We'll just have a couple takeaways here, right? We'll have all of this literature in the show notes. You can click on it if you want to do deeper research. But some of the main points to pull out of this. Number one, the best measure for inversion in connection to recession prediction is the 3-month constant maturity rate related to the 10-year Treasury spread. So here what we're going to do is we're going to view the 10-year yield and the 3-month yield. Essentially, we'll be taking the 10-year yield minus the 3-month yield. Now, when the 3-month yield, when the shorter maturity yield spikes above the longer maturity yield, well, of course, this measure is going to become negative, right? Or we can just show you the 10 and the 3, and you can see when the data series for the 3 spikes above the 10. That's, of course, when you have an inverted yield curve by this 10s and 3s measure. Now, you can see the strong relationship there in the past 4 or 5 crises in the data series presented, and it's a pretty strong predictor. In fact, using that as the predictor oftentimes washes out the false positives that we were talking about earlier in cases except for the most recent 2022-2024, which is an interesting anomaly. Takeaway number 2, the fact that the curve is inverted, negative, matters more than how extreme the inversion is, how extreme that slope of the inversion is. The fact that it's inverted is the big deal. The strength of it doesn't help you add to predictive capacity for the recession. So the fact that the slope is negative matters more than how steep that negative slope is. In the case of the yield curve indicator, the level of the term spread provides the most accurate signal of a forthcoming recession. The strength of the inversion has no bearing on the ability of the model to predict a recession in general. Well, a steeper yield curve, the smaller the impact of a given change in the implied probability of recession. Hence, the change in the spread by itself is not very informative. Another note here on persistence and strength. Now, if you're paying attention to financial press, market chatter tends to pick up even the slightest sign of a yield curve inversion, regardless of the size, regardless of the duration. Even like a little intraday inversion will set people talking. However, inversions in daily or intra-daily data, they have often proven to be false signals. Inversions observed over longer periods of time at a monthly or quarterly average frequency provide much more reliable results. Caveat here. We focus here on predicting the occurrence and not the severity of recession. There might be some anecdotal evidence that the more pronounced the inversion of the yield curve, as in the early 1980s, that they've generally been associated with deeper subsequent recessions. But that's another topic for another session. Takeaway number 3, the duration of the inversion has predictive strength. All right, what kind of duration? A 3-month negative average should trigger concern that a recession has a high probability of arriving sometime within the next 12 months. Now, all 6 of the National Bureau of Economic Research recessions since 1968 have been predicted by at least 3 negative monthly average observations in the 12 months prior to the start of the recession. Using this persistence measure of a 3-month average basis completely eliminates false positives from the past, other than the 2022, 2024, right? An inversion, even a slight one, is a simple and historical, reliable benchmark. Takeaway number 4, it's the movement in the short end rather than the long end that matters most. So the analysis reveals that persistent negative signals, no matter how slight, are reliable predictors of the model and does not depend on particular movements at the long end of the curve. So a little bit on the short end versus long end. Just as the strength of the slope of the inversion has no bearing on the ability of the model to predict a recession, so it's also immaterial how investors are influenced by changes at the long end of the curve. Yeah? The performance of the yield spread as an indicator does not seem to depend on the particular behavior of the long-term rate in isolation. I'll say that one more time. The performance of the yield spread as an indicator of recession does not seem to depend on the particular behavior of the long-term rate in isolation. If it is immaterial, if long rates are rising with short-term rates, as we'd expect from a weak effect of Fed policy on the long end, or if rates at the long end are moving in opposite directions of the short-term spread. Yeah, it's just immaterial. Note that this fact that it doesn't matter what's happening on the long end, well, that challenges the traditional explanations put forward by Krugman and by Fisher, leaving us with perhaps the Austrian theory as a big contender. Now, quick note, this recent anomaly, of course, is the 6-foot inversion maybe, because it's related to the COVID era, inversion. At the time of this taking place, right, the 10-3 yield curve is no longer inverted, though the duration of the inversion that did occur happened in the post-pandemic period, happened during that inflationary spike, 2022 to 2025. This inversion was persistent, it was strong. This was in fact the largest inversion in recent record. It was 29 months long, right? Some say recession was hidden, we just didn't see it, it hasn't been officially called. Others say that unique factors made this time different. Maybe it was the new array of policies that the Fed used to recover from the pandemic, such as the balance sheet. Maybe it was the softer impact of inflation because of their use of being able to manage liquidity with that extra tool of the balance sheet. Maybe it was something pertaining to the state of macro, high corporate profits or large personal savings balances. But for whatever reason, we've just lived through a pronounced anomaly with respect to the established statistical studies that strongly relate inverted yield curves, such as the 10 and the 3, to subsequent recession. So thank you for being here with me. This has just been a very brief tour through the nature of the inverted yield curve and its use as a leading indicator for predicting recessions, if you will.